Welcome, everyone, to the end of season 4 of the Profit Power Hour. Thank you for joining us. Really looking forward to the conversation today. My name is Brad Johnson. I am the CEO of Profit Coach and the host of the Profit Power Hour. For those of you who are new, we help property managers expand their entrepreneurial freedom by building highly profitable, self-managing companies. It's a joy to serve as CEO of Profit Coach. I love our company, love our clients, and love all of you who join us here on the Profit Power Hour. Gonna get into it, but first, as per the usual arrangement, I have some new cute photos of my children. These are my kiddos. My son David turned 4 last week, so we got some photos done for the family. They are now 4, 2, and just about 1. So we're looking forward to an awesome Christmas together as a family. And I have a very special guest for you today. There is already a comment on here, a couple comments on here of some Greg Crabtree fans, and that is exactly who we have here today. Greg Crabtree, author of Simple Numbers, speaker extraordinaire, entrepreneur, lots and lots to say about Greg. Greg, thank you so much for coming on.
Yeah, thanks for having me, Brad. I just have one question. I mean, did you get that picture for the family out of a Sears and Roebuck catalog? So I mean
That's
that just looks too perfect. So
it's this is what I found. If you are in one of those photo sessions with little kids and you just take enough photos, a couple of them end up coming up like that, and then you discard 700 of them. So,
I,
uh,
I must have done something wrong because with my 4 kids, the only photo that we could ever get was their when I we would tell them to give us a silly picture. Yes,
yes,
they complied with that.
that's when they
But
complied.
yeah,
Yes.
yeah.
Oh, yes, there were certainly lots of bribes given out, and there were treats after the photo session.
Yeah,
Uh,
that's good. Yeah.
Yes, yes. Before we go on, I think it'd be great just to take a minute. Greg, why don't you introduce yourself? I gave
Sure.
you a little bit of background. Some of our audience
Um,
is familiar with you, but for those who aren't, who are you?
um, you know, I'm kind of that practitioner that was a longtime CPA, still a CPA, but I really kind of fell in love with entrepreneurship, in the early 2000s, joined the Entrepreneurs Organization back in 2001 and really kind of found my tribe in that it's not the other accountants in the world, it's the entrepreneurs of the world. And so I see myself as an entrepreneur that helps people, with, quality data to run their business. But I almost am doing an apology tour for all of the pain and suffering that accountants have inflicted on entrepreneurs, because, we have our rules for other reasons, but I've elevated, my purpose in life to elevating the entrepreneur journey. And really, there's a lot of ways that, the things that I write about, I didn't learn from school. I didn't learn from other accountants. I learned from my really good clients that I just had to get in their head and figure out, okay, what are you looking at? Because it's not the data I'm giving you. You're looking at something else.
Mhm,
And through that pursuit, and really we live in a time that data is more accessible and studyable ever. We really uncovered, some long-term truths that have been existent in the market. I believe that they will stay existent in the market, even with the AI and robotic revolution that's in front of us.
mhm.
And so business has a tendency to work in a very contained economic model, and your industry is one of the tightest models that exist.
Oh,
So,
yes. Yes, I'm looking forward to getting into that. So we have titled, yeah, DLER. That's how
yeah.
you know. Looking forward to getting into that. So we've titled this the 2025 PM Industry Briefing, and I'll explain what I mean by that in just a moment with our agenda. First, I want to throw this out there. If you have any questions for Greg, please drop them in the Q&A box. I went pretty light on the number of questions for our time here to try to provide some space for some Q&A because I have a feeling there will be some clarifications needed. If you missed
Right.
something or we need to go back and hit something deeper. This is for you, the audience. So please throw that in the Q&A. All right, so here's our agenda. There's 3 things that I really want to get out to the world today. First is looking at the current state of things in 2026 outlook, what does the private company data signal? And we'll make a quick distinction early on what we mean by private company data and how that differs from other measures of the economy, if you will.
Right.
Number two, once we have that, how do property management companies and what we're seeing on our end in terms of property management company data and performance data, how does that compare to the rest of the small business economy? And then number three, what should we do about it? How should PMs account for current trends in their pricing, hiring, operating plan moving forward as you close the book on 2025 and get into 2026? So, first, want to put this out there, throw a poll out. Where are you looking for more clarity as you plan for 2026? You may want to answer all of these. So I'll say, what's the primary place where you feel like you could use more clarity as you start to plan for 2026? Four options here: pricing, hiring and labor availability, labor efficiency and productivity, and then the last one, just kind of general operating expenses. So as that's coming through, getting a lot of great responses on that already. I will go ahead and kick off our first question, then I'll come back. I'll close that poll, come back to it, and show you what you're saying as far as what's most important right now. So to kick us off, what is the private data signaling? Greg, why don't you give
Yeah.
everyone a little bit of an overview of your 100 company model? What is it? What does it do? Who is it designed for? And just kind of like what does it inform for the world?
Yeah, when I was writing the second book, I had a data set of 50 companies that I started with, to do some just data centered research, for the concepts that we were looking at. And then after I wrote the book, I realized, oh, wait a minute, we probably just keep this updated periodically. And we just kind of committed to updating it every month. We have companies come and go, but it's just like a stock index. You remove a company, you add a company. So it's 100 companies that are a blend of industries, a blend of geographies. Our practice is unique, is that I may be based in Huntsville, Alabama, but 98% of my revenue is not in Huntsville, Alabama. So it's all over the country, all different industries. And so we have a basket of companies that I think is a better reflection of what I think the real economy is doing. It's 1.3 billion of revenue, so average 13 million of revenue, of those companies. We don't include our clients that are above 50 million in revenue because they would create a distortion. We don't include, too many at the below 5 million as well. So we stick to kind of that size companies. And it's really proven more accurate than the government data because it's data that is presented in the same format. We touch it to get it. It's not self-submitted. And these are all companies that kind of run under our guidance. What it is telling us is, yes, revenue is up about 9% this year over last year, rolling 12 right now. But when you slice that down, it is into, the companies that are up about 15%, and the companies that are not up,
Mm,
they're down 10%. And
mm,
so here's the thing that everybody needs to understand. The economy is not even for everybody. So the one thing that makes it good for somebody is if you're a necessary. Well, guess what? You guys are probably in what I would call a necessary category in the property management. Somebody's got to manage property. Not the property owner can do it in-house or they can outsource it, but property management is a necessary, service, in the economy. What's not necessary? Street level retail. I mean, if you are a street level retail, you are getting your brains beat out right now because online ordering either direct to merchant or through Amazon or somebody else, it is so crept into the easy sales that street level retail used to require to keep profitable and stay the lights on. They're now street level retail is acting as more like a convenience store model instead of a regular sales model.
mm,
Some retailers like Orvis have gone to they view every store as a distribution and or marketing hub. And so Orvis takes an example of looking at every store as every online sale in that geographic area served by that store accounts to that store economic unit. And
Mhm.
so they're not going to open as many locations as they would have in the day when you could get profitability at store level anywhere you put up a store. But you're going to see more retailers act like that in terms of this holistic model.
Mhm.
The core services, HVAC, plumbing, electrical, those guys are doing good. However, we're seeing challenges even in those core necessary businesses because any ones that are doing repair projects or supporting construction new projects, those projects are getting significant delays in execution. And so that's telling you that the marketplace is slowing down. Some projects are in trouble of being completed because with struggles with financing and those kind of things. And so from that standpoint, even the trades are not projecting a strong number. Now,
Okay.
when I look at revenue going up,
Mhm.
and I'll give the government slack, even though their data is crap. I'll give them some slack because it's a hard number to know because we're not an economy of widgets. We do a lot of services, and so when you analyze increases or decreases in revenue, there's three factors that you got to play in and make an assertion. Number one, did you raise prices or did you cut prices? One of the two. But we're not seeing hardly any price reductions in that people run a momentary sale, but people aren't cutting prices, and which is, I think, good. Secondarily, we have a few instances in the construction market in the small end that we're seeing a couple of contractors bid to cover overhead, which is the first sign of they're headed towards death.
Mhm.
And those people will self-select themselves out of the market in 6 to 12 months. But most credible contractors are staying reasonably priced in what they're doing, and other services are staying reasonably. Price is not the issue. Demand is the issue. The second thing, is the marketplace growing for your product or service? And you know, from anecdote, it's hard. You can't put a pure measure on it, but from touching several hundred companies every month in our consulting practice, I'd say unless you're building an AI data center, still building distribution warehouses, um, you know, really outside of that, that's it. There's no growth. I mean, contrary to the administration is working off of flawed data. If they're looking at revenue increases and saying that's growth, no, we are not producing more. We and really, I would call it we're probably about -1%, and I think we've been -1%, since at least January. We were probably about +1% last year. Uh,
In
so
in in what? In actual GDP?
actual GDP growth. If you take a realistic basket of goods and services across the whole economic spectrum, I think you're about -1%. And
Mhm.
here's what I would say to back that up. There's been over 2 million people leave the country, about over 1.6 million have self-deported, over 400,000 have been forcibly deported. Now, forget about politics. I'm just talking about economics. You don't
Mhm.
take 2 million consumers. I, I don't care what you think about those 2 million people of being good, bad, indifferent, or whatever, but they were consumers. And you
Mhm.
don't take 2 million people, 2 million consumers out of the marketplace and not feel it.
Mhm.
And so tell me, this is the question I always ask everybody that wants to talk about economics. I said, listen, I grew up on a chicken farm in Alabama, so what do I know? But last time I checked, it takes output and demand. And so if you have increasing output and we have a flat to declining total population, a flat to declining total workforce, tell me how you have increased demand, because nobody else in the world's buying our stuff to a greater degree. If anything, exports are down
Mhm.
on average. And so I I'm not saying it's good or bad. I'm not saying I don't care what your political, stance is. I'm just an analyst. And when I look at it, the economy is not growing. It's not going to grow anytime soon because tell me what the catalyst is that creates growth. Now, people always say, oh, increase in AI and robotics and is the next phase of that. Great, we'll increase output. What happens in economics when you increase output and you don't increase demand? Prices fall. And one of the things, and your audience has to be aware of, your audience, probably several members of your listening audience have already deployed AI tools to increase output and productivity with less labor. Guess
Mhm.
what? You get a momentary increase in profitability, but when everybody in the market can do exactly what you're doing with those same tools, what happens to prices? They fall.
Good. Yeah.
And
Right.
and and so this goes back into, when we talk about your industry and the labor efficiency ratio that we'll make touch on a
Mhm.
little bit later in
We'll
more
get there.
detail.
We'll get there.
Yeah, and so, you know, what's LER for your industry right now? A two. What was
Mhm.
it 10 years ago? A two. What was it
Right.
20 years ago? A two.
Hmm. Hmm.
Now it,
Yeah.
it has it has moments of change, but it always comes back to that leverage ratio in that process. And I want everybody to understand that from an economics, because you need to understand this yourself and not be fed crap by people that, or just have an angle that they're, I don't have a dog in this fight other than I'm living this in this world like you are. And I'm having to
Hmm.
look at it and make, um, honest assertions of, okay, what do I see? But I'm touching $1.3 billion of data that's been pretty
Hmm.
truthful, for the last 7 or 8 years
Yeah.
that we've been studying it.
Yeah. And you've seen some patterns and some
Yeah.
correlations, and we'll talk about those in a moment.
Now, but there's a
I'm gonna
but there's
go
but
ahead.
there's a third thing to that revenue
Okay.
before we get off of
Okay.
this. That is market share.
Yes.
This is the thing that everybody should get really wired up and look at 26 as your focus, because this is the street fight economy. The boom of the growth economy of the last stage of the baby boomers is over. That was the participation trophy economy. That ended in about 22. Now we're in the street fight economy. You got to go punch your competitor in the mouth and take their business away from them. And what we're seeing is, for the first time ever, a separation of the executionally great companies are separating significantly from the ordinary and deficient companies. When you had
Hmm.
a growing market, not enough people to service the demand, your only ability was your availability. Hey, I'm ready. I can take care of it. And
I'm
people
here.
put up with crappy service.
Yeah.
I just got somebody to deal with it. Now, in a
That
flatter
is
market,
very that is very true in property management.
absolutely. And,
Has been.
and yeah. And so that's really where I think, everybody needs to look at it, going forward in 20. I've coined the phrase for our clients for 26 is the year of optimization. That this is really where now you will get growth, but you probably are going to get growth from of market share because you are executionally far superior to everybody else in the marketplace, and you will get rewarded for that.
Yeah. Yeah. That's really good. Let me throw up here real quick the listener audience plans for 2026. Where are they looking for more clarity? Labor efficiency and productivity being the winner there.
Yeah.
Pricing not being a huge concern, nor hiring and availability being a huge concern, but bucketing those last two kind of in the same place, which is the vast majority of folks.
Yeah.
Operations, productivity, efficiency, kind of what you were
Yeah.
alluding to here in optimization. I think with an eye toward that very same thing, how am I
Mm.
going to differentiate myself and grab as much market share as I can?
Well, I go back to, when we teach simple numbers business strategy, there's three components. Number one, figure out what the market needs. Not what you're selling. What does the market need? Secondly, can I be profitable delivering that need? And then third, how do I tell everybody about what is different about me than my rest of my competitors, and what's my go to market, what's the digital strategy, but more so, what is moving the needle now in sales growth is the human sales strategy. Humans are running far away more impactful right now in winning business. And yes, you need a digital footprint. Yes, you need to show up in an AI search for your capability. Yes, those are ground stakes. There's a table stakes. But
Hmm.
you've got to have a human strategy to get out, press flesh, and talk to the people that you to make your case of why do they want to work with you, and then you back it up executionally.
Yeah, yeah, absolutely. And I would say of those three steps, a lot of entrepreneurs, myself included, I've done this at times, have a tendency to invert those. How can
Right.
I tell everyone about me? I got to get my name out there. Okay, how can I make money doing that? And then finally, you start to, as you fail, because that's usually what happens in a venture like
Yeah.
that. What do
Yeah.
people actually need? You start to come back around, but you can avoid a lot of pain if you do it in the right order.
Absolutely. And finding market need is really an art, where you've got to really it's almost like a business meditation practice that you've got to get inside that customer's head and feel their frustrations and say, okay, can I solve this for you? and
Mhm.
and and really it's becoming more emotive in the things that you solve. And one of the fields of study I love is behavioral economics, and
Mhm.
really it errs on that side of understanding human behavior and what that basic need you may technically do what they want, but if you're failing on a couple of those human connection points, you're not going to be top of class.
Yeah, yeah, 100%. So I think I know the answer to this, and I think the rest of our audience probably does too. Property managers, most
Mhm.
people, they look at the stock market, it basically just goes up and to the right. It has its dips, they don't last long. They think the economy is booming. Agree, disagree.
Disagree. So here's the basic numbers. So the stock market is a closed loop economy of its own. And so if you actually study the stock market today compared to the year 2000, there should be twice as many public companies in the market that there are. So there's a limited amount of public companies to invest in. Secondarily, every day somebody runs a payroll and sends money to a mutual fund, and that mutual fund manager gets beat up if he doesn't invest that cash into the market. And so you have them making a decision every day to buy the least ugly stock, because here's the analysis. The average market price to earnings ratio right now is about 25, bounce between 25 and 30, for the Dow, S&P, Russell 1000. They're close to the same. And so that's an asinine number, because if you're a company that's priced at a 25 PE ratio, if you pay 100% of your profits in dividends, it's only a 2% yield. Now get your head around that. And so this pricing of stocks, used to, we would explain a premium value on a stock because it was the forward looking where they're going. That's not true anymore. You're pricing the stocks on what's this relative stock compared to the other in this fixed pool of things, because we've got money flowing in. And so until there are more stocks to buy or less, until money stops flowing from 401ks into the market every week blindly, because 99.9% of 401k money withheld is going into a stock-based mutual fund,
Mhm.
it it's not going to change. It's going to be
Yeah,
up.
right.
It's going to be up and to the right.
Yeah.
And so now, whenever you see that five, always when I look at the market, I just draw it to the 5 year. I never look at the low short term. Look at the 5 year view. As long as that 5 year view is up and to the right, you're good. When it flattens, that's the first warning sign. And so it's going to have to flatten for more than a month. So right after the election, the stock market was a little wonky the last 2 months of the year, but it's been up and to the right all year long, and it's going to probably keep going up and to the right unless there's just something that throws it off its path. But even the things right now that global things, what's really laughable is if you listen to the analyst, they use the same information to explain the market going up as the market going down. I mean, they are just so stuck in their own world that they really can't see the practicality of what's happening. And
Hmm.
so, yeah, so but like I said, you just, take it for what it's worth. Like I said, what do I know? I'm just a chicken farmer from Alabama, so,
And,
but I think it's
so
great.
your 100 company model, make a contrast real quick. Then I want to
Yeah,
get into property management, but make a
sure.
contrast real quick. I understand, and our audience probably understands the difference in the makeup. So in the
Yeah,
stock market, you have all this money flowing in at all times that has to be invested, or money managers lose their job. In your
yeah,
model, you have actual private small businesses, slightly larger on average than the average PM company, but definitely
right,
living in the same world.
right.
What trends are you seeing in those? We talked about this negative one, positive one.
Right.
What trends are you seeing in those that indicate that the economy is flat or slightly declining for actual regular businesses like the ones that people in here own?
Yeah, so when we look at the model, we do a slice. We look at the necessaries versus the discretionaries, and that's
Hmm.
really the one that shows that if you're in a discretionary business, you're probably down 10 to 20% this year. And so you're nice to have, you don't have to have it. And
Right.
you're trying to sell a product or service, and people say, I love it, not right now. And so it's something that can be postponed or done without. Um, and now some discretionaries are what we call highly discretionary. So you're selling to people who have plenty of disposable income, and you just have to make your case that you found the people that are really passionate. Uh, good good example of a highly desired discretionary business is someone that deals with youth sports. So, the people, the families that have money that want to play in youth sports, travel ball, that's not necessary. I mean, I didn't play travel ball growing up, but I'd love to, but I was gathering eggs and hoeing cotton, and so that wasn't going to be going to happen. And my parents didn't have the money to send me, to play travel ball, which I didn't have the skill either, but that's beside the point,
Yeah. No.
but those are highly discretionary. You look at, one of the things that has stayed, the golf country club business was in real dire straits before COVID. And
Hmm.
COVID was the gift that keeps on giving for country clubs because they're still maxed out,
Hmm.
and their membership has stayed, but they found that those customers that have the disposable income and can pay that monthly fee, but that's not necessary. I mean, you don't have to belong. So those are kind of the distinctions. Here's the other thing though that your group needs to know about. So we did another split of looking at over 10 million of revenue businesses and under 10 million of revenue. And that was shocking. So there's
Huh.
5% profit differential of higher for the over 10 million versus the under 10 million. And what's happened in the last 5 years is the under $10 million businesses cost of being in business has escalated, and it's by death of a thousand paper cuts. It's not
Mhm.
just one thing, but the overall cost of playing the game has risen. And so you really have to be uber focused on profitability when you're under 10 million, that you cannot be, blatant and spend money recklessly. You've got to really be a tight, manager. Once you get over 10 million, you've got a little more operational expense flexibility.
Mm.
And that was really shocking because I've always been a proponent of the 10 million and under entrepreneur, business. And that business was kind of the lifeblood. And really what we're seeing is a lot of those businesses have exited. We had a lot of those businesses that they could get to that $1 million of EBITDA, which is the magic, professional money attraction number. And when you have
Hmm.
$1 million of EBITDA, a lot of those people exited during the high point of the private
Yeah.
equity
Oh yeah.
purchases in 2021 and 22. And that market has calmed down. Now they're still buying businesses, and there's some transactions, in your industry, but they're a
Yeah.
couple of multiples off of their peak.
Right.
because it was unsustainable at the prices that they were paying.
Yeah, and one of the things that I've seen more recently than I was seeing 3 or 4 years ago are the amount of PM companies. Obviously, people are still trying to buy, sell. There's transactions, there's local
Mm,
transactions. The bigger fish are trying to buy the smaller fish, which makes a lot of sense as a door growth
right.
strategy. One thing
Mhm.
I didn't used to see much that I've heard 3 times in the last couple months is I went out looking to buy another small to mid-sized PM company in my
Yeah.
market, and instead
Mhm.
we just merged so that we could get more market
Right.
share and mitigate some of that just cost of doing business. Are you
That,
seeing
that's
that?
actually that's actually a smarter move. Not, I mean, I don't see it on wide scale because it's just a collision of egos. But if you can find a company that makes more sense than trying to buy a company. I
Mhm. But
run the
operate
cal I run the
hard.
calculation every week for somebody of showing
Mhm.
them how stupid buying another business is economically, at the wrong price. Now, when you get the
Yes.
right price, okay, and but most of the time, I mean, and here's the quick little example. If you buy a business for 5 times EBITDA, which is a neutral value in most senses. Well, what's your return on investment? 20%.
Mhm.
If you go win business, use money in your budget that allows you to be profitable. It doesn't cost you extra. Just you have to use the money in your budget to get results.
Mhm.
If your industry is over 100% return on invested capital from organic growth, and so you can afford to surge, business development spending to go win new projects to manage. And
Mhm.
if you're not, and that's not surging digital marketing, that's getting a capable human, which, your listeners don't may not like this, but who is the most capable salesperson? The owner.
Business owner. Yeah.
You know,
Yeah.
I mean,
We talk about that a lot in our industry. The BDM versus the business owner salesperson. There's certainly a debate there and levels of effectiveness of both. But I understand. I mean, I'll put my
and,
cards on the table.
and,
I'm the
and
CEO,
even
business owner,
and it,
and salesperson.
yeah,
Yeah.
and if you get a hired business development person, you as an owner, you still want to pair up with that person
Yeah.
because it
Right.
it magnifies your effectiveness. And yeah, somebody the business development person can take it after the introduction and move through it through the details. But the owners that get out of sales too early in the cycle are just
Yeah.
shooting themselves in the foot. So,
Yeah, totally. Okay, let's move to PM companies. So you've talked a little bit about PM companies. I want to give you some data you'll be very familiar with, the initial NARPM benchmarks, and then I want to show you for the first time some updated benchmarks, basically in the same spirit of what you're doing. You have a 100 company model, basket of companies around the country in different industries. We have a slightly more than 100 company model for companies around the United States, specifically in property management, that we've been
yeah,
doing some analysis on. And
perfect.
I want to show you how we're seeing the numbers move.
Yep.
So here we go. I'm going to go through the big six KPIs in property management and look at some shifts here. So, profitability, seeing the average profitability grow faster than the benchmark profitability, but seeing generally profitability in PM go up in the last 3 years.
Yep.
Obviously, starting at an 11% starting place, it's pretty low. There was a lot
Mhm.
of room to move. So I'm going to go through all of these, and then I want to get kind of your overall take.
Yep.
So there's profitability, DLER, and I'll do TLER in a second. DLER, very interesting here,
Mhm.
going up a good bit, around the same amount for both the average and the benchmark companies.
Yep.
I would put a lot of that on the proliferation of remote team members,
Right.
VAs, lower
Right.
labor costs. Yes, some productivity tools as well, but just cutting the direct labor cost
Right.
by a substantial amount. And I say that because here's TLER, which is almost exactly the same. And I'm laughing because you were talking about that 2.0 number. Well, there you go. 2025, 2.0, 2022,
Amazing, isn't it?
yeah, 2017, same thing, right around two.
Yep.
And so it hasn't moved. in
Right.
3 years for either the average or the benchmark, even
Right.
though DLER has gone up, management labor efficiency has gone down, management labor getting more expensive, and revenue growth not necessarily keeping up with the added expense of
Yeah.
management labor. I'm sure there are some other reasons. That's the first one that
Well,
comes to mind.
I
I'll go
well,
ahead. Yeah, go
I think what you're saying is your management labor efficiency has been going down, and as you deploy new productivity tools with management, what we're seeing the trend for next year is you're going to hold your management labor constant and produce more margin with the same amount of management labor. And so you're in a cycle now of where if you've been investing, okay, you got to put the cap on and say, listen, we got to elevate. Now, but there again, there's still that factor. You mentioned the offshore labor. As most property managers have moved to a lot of the grunt work to being offshore, that probably has kept prices for your service from rising
ahead.
as
Mhm.
it should have been.
Right.
And so as the market is kind of coalesced around that market price, and you guys are an industry where there's a pretty good sense of what market is. You can't get really crazy, plus or minus, of what the market is for pure property management services. But the other thing, though, that I don't know how much have you seen in your community, we're talking about now, though, that you can take that same management labor and start to do this. And so in property management, some of our highest performers in property management don't just do property management. They created a service company that does the repairs, handyman, plumber, whatever the kinds of properties that you're managing. What can I run, as a company that rather selling it to somebody else, I can control the quality. Now, you got to hire the people, but as you mentioned earlier in the survey, right now we have more available labor than we've had in 20 years in the marketplace. And as we say, to quote, college football concept, there's talent in the transfer portal. And so right
Mhm.
now is a good time to either upgrade deficiencies in your team or add to the team. I mean, yes, you'll still have to search through a lot of humanity to get there, but I would say that you really have a lot, some skill sets that are sitting available in the market if you want to add services. Now you got to hold them still accountable to the same, labor metrics, but the
Right.
opportunity is there.
Yeah. Yeah, absolutely. So TLER, roughly the same. Revenue per unit, again, similar to profitability, seeing the average company grow faster than the benchmark company. If you look at 317 and 335 in the 3 year time gap, that actually doesn't even keep up with CPI inflation. I'm guessing you probably have a different metric for inflation than CPI. But to make my point, 317 in 2022 doesn't quite have the same buying power even than 335 today.
Right.
But
Right.
the average company has grown a lot in this area.
Yeah. Yeah. I mean, I just put a subjective measure because we just have to kind of look at the data and feel it. I would say in true inflation is probably around still 6%, in reality. Now, like I said, you got some pluses and some minuses, but if you really look at what we pay across all business, one way or another, and one of those things that have created that compression for the $10 million and under business, their operating expenses have ballooned significantly in the last 5 years. And we used to, you could get an increase in revenue and see non-labor OpEx not go up, and non-labor OpEx is going up regardless of what revenue is doing, and that's a frightening sign because it creates compression on profitability.
Yeah, yep, absolutely. So the ratio we're seeing expenses as a percentage of revenue, fairly similar. Again, a lot of that is not necessarily the expenses not climbing, but a big move in property management towards a higher RPU, a higher overall revenue number. To
Yeah,
your point, that I would expect some degree of an asymptote there, though, because we did a lot of catch-up work to maybe some of the pricing and the revenue generation that we should have been at all along. But as everybody's
mhm.
kind of caught up to that, there is kind of a theoretical maximum that we aren't really able to go past market by market.
That's right. Right.
And then churn. This is where the industry should get a round of applause. Those are great. That's a
Yeah.
great movement there. To see the average churn rate go down to something more like 15%, and for benchmark companies in the 7%. There's been a lot of attention paid to retention, customer
Mm.
retention, and churn in our industry over the last couple of years, and I think that that's a big reason there. So, and then
Well, and that and
UAC.
that's and that's the one key that churn statistic is the one key thing that keeps professional private equity money chasing your industry.
Yeah. Talk about that a little bit more because people ask all the time, why am I getting all these phone calls? Why do these people want to buy my company? You
So
know
so
why.
so when you look at so there's two reasons of why they want to look at this particular industry. The the capital that it takes to turn over every transaction every day. You don't have accounts receivable. You pull the money, you should. If you have receivables, you're not doing it right. But you get paid first and you're holding your revenue numbers before you incur any expense. And so
Hmm.
that is massive. The average company in all industries is having to have a constant working capital deployment of around 10 to 15% of revenue. So if you're a $5 million business, you got $500,000 that you have to leave constantly in your business almost all the time, net of AR minus AP, net of those things that just turn over. In your industry, that number's zero, or
Close to
even
zero.
or
Yeah.
close to zero, or even sometimes slightly negative, depending on how you structure it. And
Hmm.
so that's a big thing. Secondly, consistency of work, of customer interaction. So when you have a recurring customer, which is your monthly recurring revenue business. So if you've got an MRR business, you guys, IT managed services, service contract, home services, alarm businesses, those are the
Hmm.
darlings of the industry because you're not, you want to grow it, but you're not afraid. You don't have to go win business every month. And those are the businesses that have a significant volatility factor. And so when you
Hmm.
have low churn and you have low capital requirement, you get an extra probably two to three multiples on your value that a company that is carrying AR, work in progress, inventory, gets a little bit of trade support. I mean, they're a walk-in investment disaster because they got too many capital moving pieces and low profitability to boot, and they have to go win their customer every day. And
Hmm.
and so that's really where the money is going to skate to, in
Yeah.
that process.
Yeah. Yeah. That's really helpful. So low working capital requirement, sticky business, high retention.
It's like it's not low, it's like no. Well,
Yeah.
you gotta have 2 months of cash. So the only working
Yeah.
capital
Too
is your
much
2 months of
cash.
cash. That's
Right.
it.
Yeah.
Yeah.
Okay. I'm going to skip through some of this just for the sake of time. I want to make sure we get to the end here. So I think you've mentioned this. Any other comments you have on why the economics of property management are so favorable? And I'll say this in our prep call, you
Yeah.
said the difference is in who executes and who doesn't execute.
Right.
And the model is easy enough to understand. It's all about execution. So I'll just give you kind of the floor on that comment and that concept.
So think about it like this. Um, with the known two LER, total LER. I don't care what's direct. I don't care what's management. If you're not profitable, you have an ability to get profitable within 30 days. And if depending on how bold you are, but if I have too much labor, I can cut. If I'm underpriced, I can raise my price. Yeah, I mean, you might have some contractual limitations of, did you tie your hands? But most of your contracts, except for some of the, if you're managing some big properties, you might have a tighter price increase contract. But if you're managing single family homes, you can probably go in and change your price any day. Now you might risk losing that person, but they're probably not going to change because the switching cost is just too much. And so your ability to make course corrections within a 2 to 3 month cycle is massive. I mean, we're dealing with companies. I had a call this morning with a client that is in a product industry that it's going to take 9 months to get out of some of uh, their their situations of poor margin and poor cost management that they've got to fix. And they you incrementally got yourself into that soup, but you can't flip a switch and get out of it immediately. In this industry and these types of structures, you can make changes. You just got to be brave and just go do it.
Yeah, yeah, absolutely. Okay. Well, getting on here right before we hit our third and final segment, want to offer my help here. So, if you want help validating your numbers, kind of going through this exercise, talking about the profitability model, the constraints in property management, the different operational things that will make the biggest difference to driving profitability for you in 2026, I would like to offer a free financial clarity call for you. So, on this call, we'll help validate your financial data, take a look at it, understand how your accounting's being done, make sure that we have the ability to get clarity for you on your business, see how you stack up to PM industry benchmarks. You saw some of those earlier. Identify your targets for pricing, for labor, expenses in 2026. Get really clear on your goals and what you want in the future, spot the biggest risks and opportunities in your current model, and then, of course, build a clear plan for next year based on real numbers and not just assumptions. Based on
So,
what you have, based on where you want to go, what does this need to look like? How do we move forward? So,
Brad, you got to add one more bullet point to that,
go ahead.
and it's the most important bullet point.
Okay.
You, as an owner, you have to set and pay for a market-based wage for the job that you do in the business
Oh,
and do
yeah.
not fake profitability.
Yes. 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 We will do that. We will do that for you before the call. You will send a P&L, and if it does not include owner compensation, we will standardize your owner compensation to the industry standard scale so that, just like Greg says, you can't fake profitability because if
And
you had
aim
to
on the high
replace
side.
yourself, that would cost money. What's that?
And aim on the high side. It's
And aim on
not
the high side.
it's not this is not a minimum game. I'll tell you,
Yeah.
I'll tell your audience, 1,000% of the time that we get clients to pay themselves a market-based wage, not only did they make more money as a salary, they made more bottom line profit.
Mm.
I
Is
mean,
that psychological
it
or
is.
yeah,
Absolutely because the people do it for stupid tax reasons, and it's like just get that out of your head, make more
yeah,
money, and
yeah.
and we work with a physical therapy group for the last year. There's a mastermind of 9 companies, and they were
Mm,
stuck at $1.5 million profit as a group for 24 months prior to us working with them. In 1 year, we elevated the profit of the group to 2.5 million run rate and
mhm.
elevated owner compensation for the group 300,000. And
Wow.
so $1.3 million change
Yeah.
just from seeing the data, what you're doing for them and giving them the clarity. That's the things that you want. Objective touched feedback that's self-submitted data is crap. I mean,
Right.
all of these industries things that you submit, you don't, there's not an effective process to submit the data in a correct way. And with what Brad's talking about, for them with their immense industry knowledge and to be able to touch your data and make sure it's categorized and accounted for correctly, and you at a market-based wage on the high side correctly,
Mhm.
that's
Yeah.
where you're going to really sing, as a business.
Yeah. And to that point, all of the metrics, all the benchmarks that you saw, all of those include two things. Everybody's standardized to the same general ledger system. All the calculations are done the same with the same categorization. And then, yes, all of those folks, all of those companies have a standardized owner compensation that's been adjusted plus or minus based on what people are paying themselves to factor that. So the average PM company in our model is 16% after owner compensation, and the average benchmark company is well in the 30s, even after accounting for an owner salary. So Greg makes a good point. Thank you, Greg. So if you're interested in doing that, that QR code goes straight to my HubSpot calendar, so you can book with me right there. Have a little bit of availability through the end of the year, or you can reply yes here, and we'll email you afterwards. Okay, let's get to the last bit. The what should we do about it? So great information here on the difference between the perceived economy, the real economy, kind of the unique position that property management companies have in that real economy. So what would you do if PM companies want to grow in 2026 and they're not looking to necessarily hire a bunch more people and tank their profitability? What would that look like for you? I know you have some thoughts on this.
So step one always starts with get profitable with what you got. So if you're not at minimum 15% profit, do not try to grow. You got to get profitable with what you got, assuming you're past startup. I mean, if you're past at least 1 million of revenue, you got to get profitable with what you got, because getting bigger does not make you more profitable. It makes you less profitable. So that's step one. And then step two is then you've got to look at, you know, the the market for every new building that comes online, there's probably one that left of some sort. So the marketplace, except in a few handful of spots across the countries, don't expect market growth. So you got to go dislodge and put together a sales plan, and that realistically is you as the owner, maybe a sales assistant that's going to, take care of things, afterwards, but you don't have to make 1,000 calls. You just got to, you got to go on probably two sales call, have two outreaches a week, and you just got to lean into it. But but once you fix the profitability pattern of the company, then you can scale, from there. But if you think that your digital strategy is going to win you business, I got news for you. The digital marketplace is dead as a door knocker right now. So,
Yeah, yeah, yeah. Okay, and then finally, how does the ubiquity of AI and office automation shift the math around efficiency? I'll bring back one point you made, which to me, and I think a little bit earlier, which is it can help if you get on it early and you do it
yeah.
well. That's not to say buy all the AI stuff, but if
But,
you're able to get more efficient, you will get early gains, but eventually everybody will catch up. Is that essentially right?
right. Yeah. But you have to do it, because it's like, okay, before there were things like, accounting programs and people did accounting, there was a lot of people that held on to manual accounting and said, oh, these computers aren't going to catch on. How wrong was that?
Yeah.
And I was an early adopter. Once I got a hold of the spreadsheet, it's like, where have you been all my life? And so I'll give you this story to talk about AI. So the same group that we talked about in the physical therapy group, the people who put that on, one of their team took 30 days and built an AI answering capable or answering agent that would answer phone calls for physical therapy practices that were focused in the regenerative therapy space. So not just basic physical therapy, complex stem cell regeneration, red light therapy, those kind of things. And so up until that point, I had never had a positive interaction with a chat bot or an automated attendant. But this was in May this year. And I sat through a demonstration of a physical therapist challenging this AI agent and tried to interrupt it, throw it off. It handled questions, reframed, reset, call to action better than any human I talked to in that field. Go forward, they launched, they did a beta launch right after that and did a firm launch in October and
Mhm.
sold a bunch of licenses. That it was a very, very successful thing. Here's what I want to point out. One, they identified the need of the market. People calling places and do not get through to a person. Now, there is pushback of AI not being a person, but I think we're going to get over that. If you do it well, they're going to like the AI better than the grumpy human. And a lot of
Still not a
calls,
person, still not a person, but they might like him more.
I absolutely, because I really like this AI agent that I was hearing because she was a lot more pleasant than anybody else out there, and a lot more knowledgeable too. So anyway, so that is one thing that they identified the market of people getting through and giving them a much more robust choice, and always giving them the option to to get to a human at a later point or call back but but they're finding 90+% of the people's questions are being handled by this AI agent that can handle multiple calls at the same time 24/7. So this is big for your industry. But here's the thing. It was developed by a person that had never written a line of code in her life and still hasn't written a line of code in her life. Now, your listeners are in two groups. There's the groups that have already played with AI. They've already put some AI agents in play. Good for you. You've been bold and you're leading the pack. The rest of you just do not have that bone in your body to do that. But fortunately, in the last 6 months, there's been a credible increase of capable guides to help you do an assessment of here are the things that are in your business that you could improve from AI. And now here's the sequence of deployment of what is the tool that we can use? Is it something that you can just use Microsoft Copilot for? Do you want to use Claude or Perplexity or take whatever, the tools that you want? But if you don't get on this train right now, you're going to get run over. And this is going to be probably more massive than even the moving to remote shift that was happened in the last 10 years.
Yeah. Yeah, I would affirm all of that. I mean, there is a lot of redundancy. There is a lot of repetitive tasks in property management. There's a lot of work that I think agentic AI can really assist with.
Yeah.
For property managers, I think where we get into trouble is the extremes of I don't want to do that. I don't even want to touch it. I don't even want to hear about it. I don't want to look at it. I'm just going to keep running my business my way. That's not going to work long term. Or the I'm going to automate absolutely everything. AI can replace my people. AI can replace everything that happens in my business. Also not wise. Most people hire property managers for that relational aspect. I have this person, I can talk to this person, they can come to my place, they can look at something, I have a relationship. But what can you augment around that with AI is usually a better approach
Yeah.
than either of the extremes.
Yeah, absolutely. And I mean, it's just amazing. We had a car service client up in Tennessee that we connected with them with a group that we knew that majored in Copilot automation, and
Mhm.
they identified like 45 projects that they could improve their back office automations, and they're just over the moon with seeing how you can make all of these things connect and do things that you never thought possible, but they are possible. Now, but what the thing is though, is you still have to have a core human in certain functions. And the emerging way to talk about it is there's always going to be a human in the loop, for the time being. And really those humans in the loop that can work with that technology are going to cost you more, and
Mhm.
you have to then get the requisite increase in activity. So
Yeah.
yeah, but here's the good thing. AI is not costing a lot right now. And so I still watching AI's business model, and
Yeah.
I'm not sure how they're going to be profitable, but
Yeah.
that's to be determined.
Unless they raise prices substantially, which
But,
might happen.
but most tools right now, if you really now be careful of doing, I've got a client right now that's doing a software license cleansing to simplify and kind of redo. And a lot of companies that have attempted this too soon are going to have to learn to back up and then redo. But
Yeah.
I think you're going to find that, I would lean more to multi-capable tools rather than a single-use tool. But if you're
Mm.
small, single-use tools can be helpful. So, be
Yeah.
mindful. But the good news is those tools are not super expensive. And you just got to get the human to be far more productive after deployment of that tool and hold them accountable for that.
Right. Yeah, there has to be a requisite increase in productivity to justify that. So,
Mm. Okay.
okay, sounds good. Well, we are at time here. So, as I throw this here, as we finish, the next thing for Profit Coach, the next thing we are doing is the Elevate Sales Kickoff in Nashville in late January. And I told you I had a giveaway. Here's my giveaway. We're sponsoring this event. Ben Smith and Kristen and Candace, but Ben used to work at Profit Coach, and we love Ben and are supporting what he's doing. And he, in return, is giving us a free ticket to give away to the Elevate Sales Kickoff. It's going to be a great event. I'll be there. I'll be leading a panel there. A number of folks from our audience here will be there as well. If you have not signed up for that, I have a free ticket to give away for this event. So the first person to email me, Brad at pmprofitcoach.com, is going to get that ticket. Brad at pmprofitcoach.com. Happy to give that to you, help you with your sales and marketing as you kick off the 2026 year. And then the next Profit Power Hour is actually going to be coming to you from the Elevate Sales Kickoff. I don't know what format that'll be, but I will be there. And so it'll be broadcast from Nashville to some degree. So make plans to join us, episode 1 of 2026 in January. We're also going to be updating the Zoom link with all the dates for 2026 soon. So you'll see that and look forward to continuing the conversation. So Greg, thank you so much for
I appreciate it.
coming on today. Our audience, as you can see through the chat, loves you and appreciates you, and we do as well. So thanks for everything you've done for property management. We appreciate you a lot.
I appreciate it. Thank you.
All right. See you guys. Have a great rest of your day and your week, and have a very Merry Christmas.